Good evening, ladies and gentlemen, and welcome to the Glen Industries Limited H1 FY26 earnings conference call, hosted by Equibridge Advisors Private Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Stanley from Equibridge Advisors Private Limited. Thank you, and over to you, ma'am.
Thank you, and a very good evening to everyone. Welcome to the H1 FY26 earnings call of Glen Industries Limited. From the management team, we have with us today Mr. Lalit Agarwal, Chairman and Director, and Mr. Chera, Chief Financial Officer. We will have opening remarks from the management team, post which we will open the floor for Q&A. With that, I would like to hand over the call to Mr. Lalit Agarwal for his opening remarks. Over to you, sir.
Yes. Thank you, ma'am. I'm Lalit Agarwal, Chairman of Glen Industries. Very good afternoon to everyone, ladies and gentlemen. It is my immense pleasure to connect with you all, and I thank each one of you for joining us today for Glen Industries Limited inaugural earnings conference call, where we will discuss the financial and operational performance of the company for the first half of fiscal year 2026. This call is particularly meaningful for us as it comes shortly after the successful listing of Glen Industries, and we are grateful for the confidence and support shown by all our shareholders and stakeholders. Before I move to the performance update, allow me to share a brief overview of the company. Glen Industries Limited is a sustainable food packaging solutions manufacturer based in West Bengal, Kolkata. The company initially began as Glen Stationery Private Limited, and over the years, we have strategically transitioned into eco-friendly and food-grade packaging segment. Today, our offerings include thin-wall food containers, PLA straws, which are also called as polylactic straws, paper straws, both are compostable, PLA as well as paper straws, U-shaped straws widely used in dairy and beverage industry for the Tetra Paks. Our products cater to QSR chains, HoReCa sector, FMCG brands, dairy companies, export distributors, and numerous private label clients. We operate from a single state-of-the-art manufacturing plant comprising of 90,000 square feet manufacturing facility in Dhulagarh, West Bengal, Havra, with our advanced production, molding, printing, and packaging capabilities. Our distribution network footprint spans more than 26 states of India, and our products are exported to over 30 plus countries across Asia, Middle East, Europe, USA, and Africa. Our growth has been guided by three core principles: sustainability and responsible manufacturing, consistent quality and product reliability, customer-centric supply chain and delivery efficiency. Now I will move on to our half-yearly performance for the financial year 26. Now coming to our financial performance for the first half of financial year 26, the total income stood at 96.56 crore. EBITDA was 20.19 crore, translating to an EBITDA margin of 21%. Net profit for the year was 8.31 crore with a net profit margin of 9%. Growth was primarily supported by high product volumes, especially in thin-wall food container, and efficiency improvements across our product lines. The steady demand in the organized food consumption ecosystem, including takeaways, home delivery, institutional catering, continues to support our visibility and revenue pipelines. As we look ahead, our focus remains on capacity-led scale and product diversification. We are now in the process of enhancing our thin-wall food container manufacturing capacity from 7,986 metric ton per annum to 21,095 metric ton per annum, which is almost going to be 150% higher than the present capacity. Additionally, we are introducing paper cups and paper food packaging products as well as plastic food containers through thermoforming, which so far are not in the complete product range. This expansion will strengthen our ability to serve large domestic and international clients, broaden our product offerings to adjacent categories, and enhance operating leverage. We are confident that these initiatives will significantly accelerate Glen Industries' growth trajectory in the coming years. Before I conclude, I would like to express my heartfelt gratitude to our customers, our suppliers and partners, our employees for their dedication and sincerity, all our shareholders and investors for their trust and support. We remain committed to responsible growth, transparency, and long-term value creation. Thank you once again for taking your time out for joining today. We would now be happy to answer any questions which you may have. Please go ahead.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ranveer Singh from Yashvi Securities. Please go ahead.
Hello, Lalitji.
Thank you, Ranveer. Nice meeting you once again.
Nice meeting you once again. Lalitji, congratulations on your listing. I just had one question. Are we going in line, like when would our capex be complete and when would the plant commission, our new plant?
Yes, right now we are in the stage of filling the land and applying for the building plan approval. We have already received the Pollution Control Board clearance and waiting for the fire license approval.
Yes.
And my target is to complete the building work by March 26 and to start the operations from April 26. This is as per the project plan. But it may get delayed if the building plan sanction gets delayed by maybe 1 or 2 months, but not more than that. But we are hoping we will commence operations by April 26.
Yeah. So Lalitji, if we see, let's say, the incremental revenue capacity of the plant would be 250-300 crores. So in the first year of operations, in FY27, how much revenue do you expect from the plant incrementally?
Incrementally, like our present capacity can contribute about 200 crore per annum. And if you talk about financial year 26-27, then I think it will contribute anywhere between 150 to 200 crore in the financial year 26-27. But from 27-28 onward, it will contribute 300 crore. So our capacity total build-up can contribute to 500 crore turnover to the company. Existing turnover.
And Lalitji, our PAT margins would be similar as they are right now?
No,
or they would be a little lower?
I have been always saying that it will be somewhere around 18 to 19%. PAT margin, no,
PAT margin.
EBITDA margin.
Oh,
PAT
18-19%.
Yeah, 18-19% EBITDA margins.
Okay. Lalitji, wish you the best. Thank you so much and congratulations on your listing once again.
Thank you. Thank you, Ranveerji.
Yes.
Thank you. The next question is from the line of Avtar Syed from Well Street Financial Services Private Limited. Please go ahead.
Hello, good evening, sir.
Good evening.
Sir, I have a question related to this. Like, can you share how the installed and estimated capacity for paper cups, plastic food containers, both injections and thermoforming, are expected to scale by FY27-28?
I think the presentation which has been shared. Have you received the presentation?
Yes.
So in that, if you go to the sheet number, I'll just tell you the sheet number. I'll just repeat the sheet number and tell you all the details are given there. I'll just open it.
It's page number 18.
Yeah, you go to page number 16, 17.
Okay.
See, in the 16, you will get for financial year 23, 24, 25. And page number 17, you will get existing capacity and what is the proposed capacity, plant capacity, and the total capacity after expansion. So if you look at the injection, right now we have 7986 Actually, it's injection and thermoforming both together. That with the plastic food container, it will jump by 13,000 and it will go up to 21,095. Paper straw and PLA straw, we are not enhancing the capacity. Paper cup will be about 7,696 metric ton per annum.
Paper cup. You're talking about paper cup, right?
Paper cup and paper containers also. It's all paper products, basically.
Okay. And sir, what would be the, along with the projected revenue, operating margins and utilization levels post-expansion?
Which year you are talking about? 26, 27 or 27, 28 or is at the optimum capacity?
Like in 27, 28, like our EBITDA margin and...
Yeah, 27, 28, we are expecting a turnover of about 500 crore.
Okay, 500 crore? Okay.
Both existing and proposed capacity together.
Okay. Got it. And last one question, how do we manage our price fluctuation in raw materials? Like we transfer our prices to our customers, or we bear this?
Our prices, as you know that the polymer prices are highly fluctuating and we transfer the prices to the customers on monthly basis. And our purchases are also on monthly basis.
Okay. And sir, last one question. Can you please give us segment-wise EBITDA margin?
Segment-wise EBITDA margin, I'll just give you. In the food container, plastic food container, it will be about 17-18%. PLA straw is about 20-21%. Paper straw is also 18-19%. Paper cup will be also 18-19%. So overall, if you look at it, it will be between 18 to 19%.
Okay, 18 to 19%. Okay. Good. Thank you so much, sir.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Am I audible, sir?
Yeah, Deepak, you are audible. Thank you very much.
Yeah. Thank you very much, sir, for this opportunity. So just wanted to understand that optimum revenue of 500 crores when you will utilize the new capex as well. So what sort of aspirational EBITDA margin we can see? I mean, 18-19% you mentioned, but that is more of a generalized, right? I mean, at optimum, what sort of levels one can...
See, this is optimum I'm telling you because in the past we have seen we are even able to achieve 20-21%. As you can see that in financial year, first half of the 26 financial year, we achieved 20% above. So 18 to 90%, I'm telling you, a very pessimistic or most optimum target we are having.
No, on a realistic basis, I mean, if you can throw some light, I mean, because what I feel at current capacity level, you're already doing 20%, right? So at higher revenue scale, ideally you should get some leverage advantage.
No, we will not get. I'll tell you why. Because PLA straws is what is enhancing the margin. But as your expansion is mostly in the food container space and paper product space, where the margin will be between 17 to 18%. So overall, that's why I'm saying that it will be in 18 to 19%.
Okay, understood. So expansion is in lower margin product. So
right, about 17-18% margin space.
So 18-19% would be a fair assumption.
Yes, that's what I'm saying.
Okay.
It may be a notch higher, but we are not talking about that. It may be a notch higher technically when we go into operations.
I got it. And I mean, is there any peer that we look at? Any competitor that is...
See, I'll tell you, you can find peer in paper products space, you can find peer in thermoforming space, but you will not find peer in the entire food packaging space. You can find in special segments.
Got it. Understood. And in terms of, I mean, opportunity size, is there anything, I mean, how large is the industry? Can you throw some light on what is the opportunity size?
Even that is also very difficult to ascertain. I'll tell you why. Because packaging industry encompasses many type of products like paper, aluminium, glass, metal, and plastic. So sometimes there's a switching taking place from plastic to paper or paper to plastic. or from glass to metal, or from aluminum to plastic. So that switching takes place. But overall, we have seen that the growth in the packaging industry is changing very fast due to many factors.
Okay.
Now, these opportunities are because even paper cannot provide a quite a good solution for liquid packaging. Similarly, for dry food, paper is a very good packaging solution. So we cannot really segmentize, but the opportunities are very high in the packaging section, and opportunities are rising because of you can say e-commerce, because of sustainable packaging solutions demand, and because of FMCG and healthcare demands, and people are looking for more lightweight and cost-effective solutions. So the plastic and paper will find good market, and plastic will find good market.
I got it. Understood. And what is the capex involved in this capex that you expect to complete in March 26?
About 100 crore. 100 crore.
100 crore. And any next leg of capex planned or?
No, first we want to implement this project because considering the size of the capex, we already have 100 crore invested, and this is another 100. So it is almost the same size what we have invested in the last 5 years or 6 years. Mm-hmm. So first we want to complete this capex, stabilize the capex, or stabilize the utilization, then only move to the next. We have projects identified, but I don't want to just jump into new investment without stabilizing the existing investment plan.
I got it. That would be it from my side. All the way best to you. Thank you so much.
Okay, thank you very much, Deepakji.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Vishal Jeju from Nikshama. Please go ahead.
Hello. Good evening, sir. I am a bit new to the company. So one thing, we are expecting very good growth going ahead. From just to confirm first on the data side, you mentioned that the new capacity would contribute around 150 crores of revenue in FY27 and then 300 crores in FY28. Is it correct?
Right.
Right. So again, sir, we are looking for very good growth both in existing capacity and the new capacity. So do we have some good order books in place, or let's say if we have some visibility that how can we achieve this big number?
I'll just give the answer. I understood your. See, in the existing capacity, we're already running at the optimum level. There's no scope of increasing revenue from the existing capacity. So whatever incremental revenue will come only from the new capacity. So that is one correction I want to make from your statement. Secondly, when it comes to the market, today we have not been able to expand capacity since last 3 years because of the space constraint. And we were just planning for the project, identifying the land and other things, and freeze all the financial plans. So since we have done this, we are in fact waiting, a lot of customers are waiting for us to start the production. So selling these whatever incremental capacity or production is going to go to our existing customer base. And maybe we'll increase the customer base a little bit, and which we are also waiting in the queue. Because we have not increased any customer base since last 3-4 years.
Okay. So, sir, how is our customer profile, like customer concentration-wise, top 5 or top 10 customers, how much revenue do they contribute?
No, we are not really, a customer concentration is there because our top 5 customers will account for maybe 20% maximum.
Okay. So there is no specific customer concentration?
Yes, because the distribution takes place in India through distributor network, and there are more than 200 distributors. Similarly, in exports also, we have more than 35 customers who are regularly placing the orders. They are buying from us. So in the export, maybe one customer is maximum 5%. Similarly, in domestic also, the highest contributor may be 5%.
Okay, got it. So can you throw some lights on the business strategies which we are developing right now? Because first you mentioned that we will achieve the growth from the existing customer. But going ahead, what are the strategies we are adopting to justify our sales growth, or let's say ramp up the production? So how are you planning, both in terms of geographic side, how are we strategizing, or on in India side, how are we strategizing to achieve this growth?
Yeah. Our first focus is that on the export and domestic, we'll maintain the same ratio, similar ratio. Like today, we are exporting almost 35%. So we'll maintain the ratio around 35 to 40% in export segment. That is one. We are very clear on that because that balances our risk on the marketing front. Now, this is one factor which is very important for us. Secondly, to get new customers, naturally, we have not been participating in the international exhibitions for last 2-3 years, except some major ones. So we will focus on more international exhibition participation to attract more new customers. But our existing customers also going to give us a good volume.
Okay. So we do have some, not. Hello.
Yeah, we are not really. We will not be focusing first on the new customers. First, we'll focus on the existing customers, then focus on acquisition of new customers. And in the domestic, we have not increased our distribution base because of the non-availability of capacity. So that we will do after we have the available capacity.
Okay, so our existing customers are itself demanding higher orders, which we don't have capacity right now. So focus would be first on to expand. Okay. And sir, you mentioned that our current existing capacity at the peak utilization, that you mentioned for all the three segments, or it is just for the thin wall food container?
I'll tell you, food container is running 24/7, and we are at the optimum capacity. When it comes to PLA and paper straw, they are seasonal products.
Okay.
They are highly seasonal. So in the season, they will run at 80 to 90% capacity. Off season, they may run at 10 to 20% capacity also.
Okay, got it. So can you, sir, give me just the idea that how should we assume in terms of the optimum utilization for all the three facilities, like TW, thin wall you mentioned we are running almost at the 100%. But plastic straws and paper straws, it is a seasonal product. So on an annual basis, how much optimum utilization we should assume?
We should assume average utilization over 30 to 40% at the most.
Okay. And the paper cups, will it be of a similar nature or it is an annual sort of a business?
Paper cup and paper products again will be similar to food container where round the year demand is there.
Okay. So that will also have a round the year demand.
Right.
Yeah. Okay. So just going on to the financial front, we have debt as well and we are doing aggressive capex as well. And while we need, for the aggressive capex, we need working capital demand as well. So do we have enough surplus cash balance or are we looking for any fundraise going ahead, to suffice our capex and
working capital? My banks are ready to finance as much as we want. There is no dearth of finance for us.
Okay. So do you see this borrowing going to increase going ahead?
Yes, of course. Quantum of working capital requirement will increase as we expand the capacity, as the turnover increases.
Okay. So what would be the peak borrowing, let's say if you have assumed for the new capacity, how much?
27, 28, I am estimating around maybe 120, 130 crore.
120, 130 crores incremental borrowing, right?
No, total.
Okay, so right now we are at 120, 130 crores only. And we'll be at the similar stage.
Right now we are at around 50 to 55 crore. And this we expect to jump to around 120 crore.
Okay. Long-term borrowings would be 100 and short-term, including short-term borrowings, you mentioned
This is working capital borrowing.
Okay. That would increase.
And the term borrowing will also be there because the entire project is not funded through the equity part. It is partly funded by equity and partly by borrowing. So around 50 crore we will borrow for the project.
Okay, so our total debt, including long-term and short-term, would roughly be ranging around 200 to 225, right?
No, about 170 crore, 170 to 175 crore.
170 to 175. Okay.
Yes.
Yeah, that's it from my side. Thank you.
Okay, thank you, Deep.
Thank you. The next question is from the line of Shruti Malpani from Arth AIF. Please go ahead.
Hello, am I audible?
Yes, Shruti, you are audible.
Yeah. Hi, sir. Good evening.
Good evening.
So, I'd like to ask, sir, this split for H1 and H2 were almost 51% to 49%, as I could spot in the last FY. So I just wanted to understand, like, why do the bottom line, PAT margins differ? Like for H1 FY25, they were 10%, and H2 it was 11%, and now in this H1 FY26, it's 9%. So I'd like to understand how does this, differ in
First, you have to understand the financial year 25 margin, PAT margin. Financial year 25 PAT margin was higher because of the higher realization from PLA stores vis-a-vis the raw material purchase prices. Now, because of competition, we have to pass on the part of the reduction in the raw material cost in 26. So because of that, there's a slight dip in the PAT margin compared to financial year 25-26. And in the straw business, what happens? The season starts from February, goes up to June. So part of it comes into the second half and part of it comes into the first half. So last year, PAT margin was higher because of the reason which I explained to you, because the high realization vis-a-vis the raw material cost. And that is getting reduced. That's why it has come down a little bit. I think I'm clear to you.
Okay. The second question that I have is, what is an order book that you were expecting to achieve by FY26?
Yeah, this is like a FMCG product. We don't maintain order book. We maintain stock and we try to deliver X stock in the current market. Against the stock, like suppose we get the order, we try to deliver it tomorrow. That's why we maintain a finished goods inventory for the domestic market. Now, when it comes to export orders, we certainly have the order book and we manufacture against the order. So we always have a 3-month order book in hand for exports.
Okay, so what is that currently for our exports?
It currently is about, you can say, 1.5 million to 1.6 million order book in hand.
Okay, got it. And also, just wanted to follow up on a previous question. So, in the AGM in September, the fire department approval was still pending.
Yes.
So I'd like to follow up, what is the hold-up that's been there?
See, actually,
even now as you're standing in November?
Yeah, I'll tell you, Calcutta has, like West Bengal, after Durga Puja starts, practically all the government departments, they go to sleeping mode.
Okay.
so it is, we applied in August and like they will take up, let's say, start scrutinizing the application, and by that time the puja starts. Okay. And the government department has just opened back after Diwali and after Chhath Puja, they have just opened back and now they have started functioning. So we expect that in this month we will get the approval through.
Okay.
Because
Thank
they
you so much,
scrutinized initially, I just want to add, they initially scrutinized and whatever amendment they wanted to do, we have done the amendment and we submitted to them.
Okay, got it.
So it's just a mere formality actually now.
Okay, sir. Thank you so much. That's it from my end.
Thank you. The next question is from the line of Aditya Saraf from Swarm Advisors. Please go ahead.
Good evening, sir. Am I audible?
Yeah, Aditya ji, you are audible.
Yes, sir. I just want to ask one question. Is that I was going through your DRHP. Can you just tell me the location of the new manufacturing facility?
So you mean to the new facility where it will come up?
Yeah, the location of that facility.
Yeah, you see, I'll tell you what. Our existing, are you aware about, you are familiar with the geography of Kolkata and Havda?
Yeah, I'm somewhere aware.
Okay, so see, our existing factory is on the Bombay Highway in Food Park and Poly Park.
Okay.
That is around 30 kilometers from our city. Now, new factory will come up after Uluberia in Bagnan. We changed the location from the proposed facility earlier to a new facility because of many reasons. And the foremost reason was that it is in line with our existing facility. So we can share the resources with our existing facility in many ways. Otherwise, it was in a diverse direction where it would have been more than 100 kilometers from our existing facility. So from the management point of view and from logistic point of view, we changed the location to the new location.
Okay, sir. And this is why as mentioned in the DRHP, our commencement and completion date has been delayed. which was prior to that Moza, Jogram, JL, West Bengal.
Yeah, it was Jogram, and we were targeting for January. Now, because of change in location, now we are targeting for March.
That is April that you have mentioned.
Yes.
The commencement. And concern, sir, can you just tell me the numbers for FY27 and how much with the capex included, how much revenue we are expecting and FY27, FY28 also?
See, from the current operation, you can expect about 200 crore turnover. From the incremental capacity, we can expect about 150 for the financial year 26-27 and 300 crore for the 27-28. So if you sum up these, then 350 crore in 26-27 and 500 crore in 27-28.
Okay, sir. Thank you so much.
Yeah, thank you.
Thank you. The next question is from the line of Vibhor Tomar, an individual investor. Please go ahead.
Yeah, hi. I think my questions are already answered, but just to clarify maybe once again, I think I was wanting to know about the debt. And I guess sir already mentioned that the peak debt will be around 170 crores.
Yeah, absolutely.
And that is by FY28, right?
Yeah, right. That will be in the FY27-28, at the end of 28.
At the end of 28, okay.
Yeah, and by that time, all the long-term loans of the company will be repaid almost. Existing
will be
ones.
repaid. Okay.
Yes.
Okay. And sir, how much internal accrual you are putting in for this plant?
Internal accrual, see, I'll tell you, the project cost is about 100 crore. Out of that, 47 crore we have raised from the public issue, 2.5 crore we have already invested, and 50 crore we'll take as a borrowing from the loan, from the bank.
Okay.
Internal accrual will be going mostly towards the repayment of the existing term loan and towards the margin for the working capital.
Okay. And what will be the rate of interest for this loans which you get from the banks?
Now it is around 8 to 8.1, 8.2%. And if the repo comes down, it will further come down. And if we get some subsidy on the MSME, that will also reduce the interest burden.
Okay. Wonderful. Yeah. And so what will be the depreciation per year which will be added for this new capacity?
Existing depreciation is about 6 to 7 crore. And in the new capacity, we'll add almost a similar amount, so 13 to 14 crore.
13 to 14 crore. Okay.
So
wonderful, sir. Yeah, got it. Thanks a lot, sir. Yeah.
Thank you.
Thank you. The next question is from the line of Vishal Jechu from Nikshama. Please go ahead.
Hello, sir. Thank you for the follow-up. Sir, in H1, can you just give the breakup of all the three segments revenue contribution?
Revenue contribution, sector-wise, I think I don't have right now. Maybe with me. If you want, I can, if you send me an email, I will furnish you by the email because I don't have the same readily available.
Okay, no worries. I will send an email. I was just asking because I just wanted to know, we had said that we can do 200 crores of revenue in peak, and you mentioned plastic straws and paper straws are seasonal in business. So just wanted to know that season comes in H2 or in H1?
No, I said earlier, the season starts from February. It starts picking up from January middle, peaks in February, March, April, like the summer. As the summer picks up, the season picks up. And when the monsoon starts, it starts depleting. It starts going down. Then again start peaking in the festival season of September, October.
Okay. So in H2, we will see incremental growth only from these two segments because our existing food container is already at peak utilization.
Right.
Okay.
So second thing on H1 also stores have contributed for April, May, June, but this time, as you know, monsoon came early, so it has affected the store sales quite badly. All the beverage companies have suffered because of the early monsoon. That you must have read in the paper also.
Yes, but sir, how does monsoon impact this segment?
Yeah, because when monsoon comes early, the beverage sales goes down. And when the beverage sales goes down, our store sales goes down.
Okay. So directly related to beverage industry. Got it.
Yes.
And sir, second thing on the competition front, if I see, just look at the peers who are into this food container or let's say paper straw, different segments, they are witnessing a margin impact since last, let's say, 2 quarters, 2-3 quarters. But we have maintained our margin. We have maintained our margins in H1 as well, and we are maintaining since last 1 to 2 years. So any key reason for that? How are we able to maintain these margins?
I don't know, because
is it a...
See, if you start talking about the peer, you will not get peer in the store sale. There's nobody in the store which is listed company or whose data is available easily. They're all in the either a small sector or a micro or a small sector. When it comes to food container, yes, there are many peers you can see, and in the thermoforming as well as in the paper products.
Yes. So the margins which we are able to maintain, that I just wanted to understand from the raw material point of view. Is it because
it is raw material procurement is important, as well as how much, like our products, even food container, they command a premium in the market. So if your quality is good, if customer acceptance is good, you can command a little bit premium, which maybe an inferior quality producer will not be able to command. So that's why we are not doing any food selling.
Okay. Yeah. Got it. And so one other question, do we have any other group businesses or other businesses apart from this Glen Industries?
No, we don't have right now anything.
Okay. And one thing on the working capital front, our inventories have increased significantly in this H1. Working capital wise, how are you?
No, in the inventories have not reduced. It has reduced, in fact, not increased.
Okay. So, on the working capital front, broadly, how are we looking after this? Like, currently our cash conversion cycle is way higher. So, how are you planning?
It will be getting better because we don't have to then stocks that much as we are doing right now. Because there will be continuous flow of raw material. Plus, in the new segment, like paper will be coming from the domestic supplier. Then in the thermoforming, most of the material will again come from domestic, but depending on the pricing delta, we can.
Ladies and gentlemen, the line for Mr. Lalit has been disconnected. Please stay connected while we join them. Ladies and gentlemen, the line for Mr. Lalit has been connected. Over to you, sir.
Yeah, sorry, ladies and gentlemen, the line got disconnected, and we can continue with the question answer session.
Hello.
Yes.
Yes, so you were speaking on the working capital front, like how are we planning to improve our working capital?
Yeah, basically working capital cycle, we are expecting that it will improve after the new project because of, one is the paper is locally sourced, so the less inventory, that means. Secondly, thermoforming products also, the raw material will be sourced locally unless we find imported is cheaper. So that will also reduce the inventory level. Because inventory level, why we have to maintain high of the raw material is because we are importing a lot of raw materials. And not to be out of stock because of uncertainty in the shipment time, we maintain a lot of.
Okay. And sir, our margins in domestic and export are at similar level or
similar level?
They are
Our
different?
pricing pattern is for similar level margins. We are not distinguishing between export and domestic except the raw material cost. Because domestic raw material costing is different than the export raw material costing. But margin-wise, it is same.
Okay. And how much of the percentage of raw materials we are importing versus locally sourced?
Right now, like if you talk about plastic, we are importing almost 80%, 80-85%. When it comes
85% we are importing.
Yes, when it comes to paper, we are not importing at all. And when it comes to PLA, we are importing 100%.
Okay. So we are importing 80% plastic. So is it like a cheaper? We are getting raw material cheaper from import or
not only cheaper, but those grades are not available easily in India. The grade we use for making thin wall food container, they are not available in India.
Okay. And major import is from which country?
Abu Dhabi.
Okay. From there we are importing. And paper we are mostly sourcing from the domestic market only.
Domestic market. PLA is 100% imported from China.
Okay. So just one last question. Do we have any geographical revenue split in India, like eastern region, western region? Do we have any such?
Yes, we have that. We have that.
Okay. What would be the broader?
We have even state-wise. May not be having readily. I can give you a rough figure, one figure, but we have even state-wise figures available with us.
Okay. So any rough figure from the region-wise, east, west, north, south?
Eastern India is about 35 to 40% of the total revenue. When I talk about only domestic.
Okay.
Northern India will be 25. Southern will be 25. So balance 15% will be about Western India.
Okay. Yeah. That's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Kirti K. Jain, an individual investor. Please go ahead.
Hi, sir. Good evening.
Good evening, Kirti ji.
Sir. Sir, with regard to ensuring the project is coming on time by March, what are the steps you are taking to ensure that it is on time, sir?
Actually, we are only waiting for the building plan approval. Once the building plan approved is in hand, then everything is frozen. After that, we know that how much time we already awarded the contract for the building. We already issued the purchase orders for the machines, for the injection molding machines. Now we are in the process of, I visited China 15 days back, and we are in the process of finalizing the orders for the thermoforming machines. So we are already started working on the various critical things. So only aspect we are waiting for is the building plan approval. That will be applying after fire approval. Building plan approval will be applied. Once we get that, the construction will start immediately. The land filling is already going on, and piling also will start before the even building plan sanction comes in hand.
Okay, sir. So by March, the site will be ready, sir, to all the installation.
Yes. We are expecting by March we should be able to start production, at least if not in all sections, at least in the thin wall injection section.
Sure, sir. And then, sir, at the year end, what will be our debt level, sir? Term outstanding and working capital outstanding you expect at year end?
If I don't talk about the new project, because new project term debt lending will be associated with the import of the new machines. So if I don't talk about that, then from the existing operations, it will be about term debt will be about 16 to 17 crore at the most.
And working capital, sir?
Working capital will be about 55 to 60 crore.
Okay. And sir, just one clarification, sir. Currently, we are having a 9% PAT margin. So this 9% PAT margin should be broadly sustainable, right, sir, going into 1 year?
Yeah, basically, I am not very particular about the PAT margin. I look at the EBITDA margin more clearly, because then depreciation is something which is can be fluctuating. Interest can be fluctuating depending on the debt we borrow. But if you talk about EBITDA margin, then we will be in the bracket of 18 to 19%.
Okay.
After that, whatever interest, whatever depreciations are there or tax payment we have to make, that is only deducted.
Okay. So any large capacities are coming from the competition in our area of business or lines of businesses, sir, in the short to medium term?
I don't think any major capacity is coming in India.
Okay.
People actually in our packaging industry, people don't plan big projects. They try to implement one machine, two machine like this. What we have done also earlier, bring 5 machines, 7 machines together, then increase the capacity. Again, bring 5 to 7 machines, increase the capacity. This is how people do in general.
Okay. So in terms of entry barriers for validation...
Sorry to interrupt in between, Mr. K.
Last question from my side.
I would request you to please rejoin the queue again, as there are participants waiting in the queue.
Yeah, thanks a lot, sir.
Okay, thank you, Kirti. You can talk to me personally, there is no problem.
Thank you. Ladies and gentlemen, due to time constraint, we request you to kindly limit your questions, one per participant. The next question is from the line of Bijul Shah from RTL Investment. Please go ahead.
Yes, hello sir. Thanks a lot for opportunity. I'm a bit new to the company. I just want to understand, you're talking about a very strong growth in coming 2 years. So, what is driving this growth? Is it that industry itself growing much faster, or you are going to grow, you are going to take market share?
So basically, the growth will be coming from the new capacity because we are in the manufacturing-based industry. So we can sell what we produce. We cannot sell something by trading. So our growth...
Well, I understand, but there must be, somebody else must be supplying to those guys right now.
Like a lot of shifting taking place from China to India. You must have heard about it, China plus one policy. So many of my customers, they want to shift their many buying from China to India. In fact, some of them already shifted some more from China to India to me.
Okay.
So it is a substitution takes place, expansion takes place, and the availability. All the three factors combined will give the growth.
Okay.
Right now, I don't have availability. So if any customers come to me, I say I don't have available any product right now.
Okay. And okay, I'll just join the queue. I have another question, but I'll join the queue back.
Thank you. A reminder to all the participants, you may restrict your questions, one per participant. The next question is from the line of Shruti Malpani from Arth AIF. Please go ahead. Ms. Shruti, please proceed.
Am I audible now?
Yes, Shruti, audible.
Hello. Yeah. So just a follow-up question on the debt levels so we are saying that currently we are at debt level of 50 to 55 here, which is expected to go to 120 to 130.
55 is for the working capital. And
okay.
15 crore is for the term debt at the end of financial year 26.
15 crore you're saying or 50?
15. 55 for working capital and long-term debt is 15 crore, so total 70 crore debt from the banking institution at the end of FY26.
Okay, so long-term borrowings. Okay.
Long-term, short-term both together, 70 crore.
70 crore, because sir, currently the H1 numbers, I could see that we have long-term borrowings of approx 35 CR and short-term of 80 CR.
In that you will find a lot of promoters loan also included, lot of other things are also included. But from the institution, it is only about 70 crore. We will be 70 crore at the end of 26.
So the 120 to 130 CR figure that you're saying for FY28, that's also only at the institutional level, not including the promoters borrowing.
No. You leave aside promoters borrowing, only from the banking institutions. If I talk about 27, 28, then this 55 will go jump to 120 crore. And this 15 crore will be repaid and fresh borrowing of 50 will come. So 120 plus 50, 170 crore.
Okay, sir. Thank you so much.
You're clear about it now?
Yes, sir, I am.
Okay, thank you.
Thank you. The next follow-up question is from the line of Avtar Syed from Wealth Street Financial Services Private Limited. Please go ahead.
With the follow-up question. So I just have one question, the RHP you mentioned, Rajshri Polytech Limited is your fee, but their debt level and debt to equity level is quite lower compared to us. So what is the main reason we have such high debt compared to our peer?
I'm so sorry to interrupt in between, sir. Your voice is not audible.
My voice is audible?
Yes.
So actually it depends on whether the company is expanding or not. If I don't expand, I will repay my term debt and I can be just operating at the same level. You have to see the growth also together with the debt. So if the debts are rising, that means the company is growing and the turnover is also rising. And company is putting investments into the capex.
Okay. And sir, if we can say our company don't have any entry barriers. That's right, we operate in B2C, B2B segment.
No,
and
we don't operate in B2C.
I mean B2B. Sorry, B2B. Yeah. And also in straw and all of this plastic containers, people don't prefer any brand and kind of things. So we don't have any moat or entry barrier in our business.
No,
Is my understanding right?
you're talking about the government legislation, I think. Entry barrier is different.
No, I'm talking about our business.
See, business entry barrier is, no business has any entry barrier except investments. If you can make investment, if you have market, you have entry barrier is nothing. You should have the market first. For any business, market is foremost. Secondly, you should have the investment taking place. This is applicable for any business.
Okay.
I think I'm clear on this.
Yeah. Thank you. Thank you so much.
Thank you. As there are no further questions, I now hand the conference over to Ms. Chandni for closing comments. Over to you, ma'am.
Thank you. On behalf of Glen Industries and Equibridge Advisors, I thank everyone for taking out the time to join today's earnings call. If you have any queries, you can connect to us at info@equibridgex.com. Once again, thank you for joining the call. Thank you, Lalit sir. Thank you, Chirag.
Yes, and thank you, madam, and thank you all the participants. Thank you very much for joining in and for patient hearing.
Thank you.
Thank you very much. On behalf of Glen Industries Limited, that concludes this conference. Thank you for joining us today, and you may now disconnect your lines.